Hey, what's going on, everybody? Teddy G back here. That was back here pretty fast because I posted a video a couple days ago about the family attribution rules and my take on them. And guess what? I was blown out of the water. I received a nice email from Dan Shoden, who's a follower and is also a tax partner. This is Dan right here. He wrote a great article discussing the most recent developments. And he's written a lot of stuff on attribution rules and basically telling people to be cautious about them. And while I agree that there was need for caution before, there was enough vagueness for me and thousands of other practitioners to keep pressing forward with taking the credit for single shareholder entities and some family members that qualified and whatnot. Well, guess what? Yesterday, the IRS posted a new bulletin 2021-49, where they basically said, nope, they added much more guidance on the attribution rules in section 267, to my shock and disappointment. Let's put it that way. I'm going to try and keep my emotion contained here. So let me share my screen and dive into this some more. And by the way, this video is really for everybody, all citizens of the country here, whether you're an employee somewhere or you're, obviously this is for small businesses because basically they shot us down. But really this is pretty scary as far as just how little we're represented in Congress, no matter what your political stripes are. And I'm not going to get into the politics of it because I don't really, politics is not my religion to begin with. So let me go ahead and share, but everyone, this is for everybody. So hopefully everyone watching, you may not understand everything that I'm talking about, but you should try and follow along here. So, and I'll do my best to kind of keep this as easily understandable and digestible as I can. So here's what happened yesterday. This is what they published. Notice 2021-49. And this notice provides guidance for retention credit of the Internal Revenue Code enacted by Section 1951 of the American Rescue Plan Act. What we're going to figure out is that the American Rescue Plan Act wasn't designed to rescue small businesses with respect to ERTC. All right. Well, that's the first shocker. Although we all were, more or less nervous about, what eventually the final guidance would be on the relationship tests and things like that. But there wasn't enough in FAQ 59. Basically, in a nutshell, if we all remember, this FAQ 59, which was pretty much a copy and paste of the section in the CARES Act, said that if you're related to 100% owner or a 50% or more owner of a business, if you're related in any way, you weren't eligible to take the credit. If you were these people, this was the initial interpretation. This is how we would interpret this FAQ. If they wanted to not, if they didn't want to confuse anybody, they should have never even published this to begin with. Or they should have just said, except for family-owned businesses and 100% owners of businesses. But they didn't. They buried all of that minutia and vague interpretations in Code Section 51I1, which referenced 267C1. Right here, and for those of you not in the business world, all they should have done here was say, all of you small business owners, whether you're 100% or whatever, it doesn't matter if you're related in any way, even if they're not even employees, you can't do it. And what's funny is that it says here, a related is any employee, right? Let's go real quick. But according to the recent guidance in 2021 now, They're saying, no, it's anybody, related. They don't even have to be an employee. And if you're related to anybody, they assume your shares. You're attributing your shares to them, giving them what we call constructive ownership in your business. Therefore, if you're attributing 100% of your shares to a family member on the other side of the world, you're related in that respect, and you can't take the credit because they are essentially a 50% or more business owner, and because they are a 50% or more business owner applying constructive ownership in Section 267, you can't take the ERTC as 100% owner of your own business, even though it says this is a related individual as any employee who has a relationship. A little contradiction there, you think? Yeah, I'd say so. Let me go into my Section 51 here. Oops. Let me go here. Let me open up another tab. Sorry about that. So let me go to my little research tab, Section 51. Let's see what it says. So wages shall not include amounts incurred by an employer for any period to any individual. Sorry. Hang on with me. There's a lot more to this. So hang in there. I'm kind of doing this on the fly. I'm just so frazzled by all of this. It's just unbelievable. Certain individuals bears any relationship described above, taxpayer's corporation, if taxpayer is an entity other than any individual owns directly or 50%. So in Section 51I1A, there's no mention of these people as employees, okay, from what I can see reading this. Yet FAQ 59 confuses everybody and says a related is any employee, right? So anyway, let's continue from here. And everyone's like, you can't, FAQ 59 is not authoritative. Well, guess what? Thank you for sharing that little piece of information. But as we all know, with what happened last year and is continuing to happen, we still have to file tax returns. We have to interpret whatever we can out there. We don't know if these are final regulations. We don't know. We have to go with the intent of the law, right? And that's the guiding principle for us as practitioners. We have to do what we can in very short order to determine if some of these people are qualified or not. So yes, we can look back at 51I1, and it doesn't reference that they're an employee. It just spells out that it's a relationship, okay? And then if you go to 267, well, 267 talks about losses and expenses. And this is 267 is a code section that talks about selling shares of stock to individual family members and provides guidance on where gain, amount of gain were lost previously disallowed, wash sales, transfers from what's that got to do with the credit? So it was easily dismissed by most of the practitioner community because it didn't apply. It didn't provide any guidance. It didn't apply back to anything. Here, 267 is talking about a controlled group. So this was designed, 267 generally designed to help eliminate the abuse of family members selling their shares of interest in their stock at losses and passing along those losses to each other. Generally, in a nutshell. I mean, I'm not an expert on 267, but if you read this, and you could understand, why there's guidance on, relationships and as far as, who's a control group and how you shift around income and things like that. I mean, but so we dismissed it, right? Even though 51 references 267C, if you go back to FAQ 59, even though it references it here, they basically made a mistake apparently, or they did this to confuse everybody. I don't know. I really don't know. We knew that this was rolled out very quickly, And we did our best to follow the guidance that was out there. How any sane practitioner can apply 267 to the actual ERTC credits beyond comprehension. And I know a lot of people were saying, well, it's the same code section used in worker opportunity credit, totally different credit, totally different circumstances. We're not talking about a smashed economy under worker opportunity credit. We're not talking about a Rescue Plan Act. So again, context and perspective is very important. But the worst part about it is what we saw yesterday, and this is after I published my own opinion on the attribution rules the day before yesterday. So my timing was excellent as always. But let's remind ourselves that this is the American Rescue Plan Act, right? And if you read through it, it has some guidance. I kind of paraphrase and just cut and pasted some of the more important things that I noticed in Notice 2021-49. Well, first of all, let's talk about intent. We talked about intent here, right? Intent, and here they threw this little qualifier. Let's call it a qualifier, right? You remember, tax experts, qualifiers, lawyers out there, CPA attorneys. So they threw this qualifier out there, which in our opinion defined what the intent was of FAQ 15, how to interpret the regulations. Okay, let's skip aside the minutia and the detail in 51I1 and 267. We already talked about 267 having literally no practical application, especially when taken in context and reading FAQ 59. Okay, so, but here in the notice itself, when they're discussing whether a 501c3 tax exempt organization should be able to be treated as an eligible employer, it says indicating an intent by Congress. Indicating an intent by Congress. So we see intent here, plain as day. So are we going to be that arbitrary where we allow them to clarify and indicate their intent in certain when interpreting certain code sections and not others? Is that where we're at? This is why this is ridiculous. So anyway, let's go to the nuts and bolts of how this pretty much shoots down the eligibility for family-owned business for 100% majority owners of their stock and giving their ERTC to family members. So this is the guidance this is the amplification of the guidance. The majority owner of corporation is a related individual for purposes of the employee retention credit whose wages are not qualified wages if the majority owner has a brother or sister, whether by whole or half-blood ancestor or lineal descendant. That is, applying the constructive ownership rules of 267C, the direct majority owner's ownership of a corporation is attributed to each of the family members with a relationship described in 267C4. Further, because each of those family members is considered to own more than 50% of the stock of the corporation, after applying Section 267C, the direct majority of the corporation would have a relationship as defined in 152, etc., to the family member who is a constructive majority owner. Therefore, the direct majority owner is a related individual for purposes of the employee retention credit. So, common language here, which I kind of touched briefly on just a little while ago, doesn't matter. They don't have to be employees. So they're contradicting what they don't have to be employees. They're contradicting what FAQ 59 said. Okay, that's number one. There's a contradiction there because they're basically saying anyone you're related to, anybody, literally anybody. You in other words, you have a brother, like I said, you have a business in New York, you have a brother in California, there's no relationship whatsoever to your business. You have to attribute your share of stock to him. So now he becomes a 100% owner in your business constructively. And because he is a 100% owner, you have to apply the 50% or more than 50% test to qualify for ERTC. And so since you're related to your brother who has nothing to do with your business, and he constructively owns 100% of your stock, he's more than 50%. Therefore, you can't take the ERTC. And this just, it goes on. And that this is basically the link in the theory that eliminates ERTC for majority shareholders, or quite frankly, any shareholder, because you're all attributing the stock to each other. So it becomes really, really messy. And then it goes on and on and on about this. And again, nothing to do with a related individual as an employee, contradicting guidance. Okay. This is very contradictory. Of course, they're going to say, well, this is not authoritative. Thank you very much. And then how is this authoritative to apply code section 267 when it's discussing stock sales? How is that authoritative? Apparently they just feel like they're going to make it authoritative. Okay, great. Thanks so much. Here's an example. All I did here, I copied and pasted from notice 2021-49. All right. These are the examples. They start out with Corporation A, very impersonal, of course. Everything's very impersonal. People don't have names. They're just individual E, F. All I did is I copied and pasted this. Let's run through this with actual names of businesses. So Coffee Love is owned 80% by Mike and 20% by Sarah, Mike's daughter. Sarah is a child of Mike. Coffee Love is an eligible employer with respect to the first calendar quarter of 2021. Both Mike and Sarah are employees of Coffee Love. Pursuant to the attribution rules of 267C of the code, both Mike and Sarah are treated as 100% owners of Coffee Love. Sarah, I mean, they repeat themselves. Sarah has a relationship to Mike, described in code section 152D2C of the code. Mike has a relationship to Sarah, described in the same section. Accordingly, Coffee Love may not treat as qualified wages any wages paid to either Sarah or Mike, because both Sarah and Mike are each related individuals for purposes of the Employee Retention Credit. Can you imagine that? This is what the American Rescue Plan Act was intended to do, was to eliminate this coffee shop from being able to take the credit for father and daughter who own their respective shares and are working, around the clock to just maintain order and keep things going. I don't think that's proper. Let's put some color into this for context and perspective. Mike and his daughter, these are my words. All right. These are my words. For context and perspective, Mike and his daughter own a coffee shop together and receive wages. They are the two main employees of Coffee Love and have a few other part-time employees. The revenue significantly declined because of the shutdown orders and meet the gross receipts test criteria. They still managed to keep the doors open, spend money to build barriers by their counter, and bought special sanitation supplies and did their best to comply with state and local guidelines to stay open. Since they didn't close and generated a fraction of the income they were generating, they had to receive their wages accordingly. They had to reduce their wages accordingly and did not qualify for unemployment benefits or PUA. We'll get to that in a second. They receive a small PPP. They receive a small PPP loan, which is only 2.5 times their average salaries. They will not qualify for ERTC based on, in my opinion, the inappropriate application of Section 267. Okay, think about that. Is that the intent of Congress? To basically eliminate this small business from taking $5,000 each? And guess what? And this as practitioners out there that have small businesses that were severely impacted. As I told you, I have a lot of Main Street businesses like this, and my revenue went down 60%. My own revenue went down 60%. You mean to tell me that these individuals, because apparently there's an argument out there that says, well, you have to protect, you don't want abuse of the rules, and you want to hire all these family members. Well, first of all, you're making a huge assumption that people are criminally minded, want to commit tax fraud, and do all these other things to benefit themselves. That, are you serious? I mean, that's what we think of ourselves as neighbors and citizens. We're all criminals. I don't think so. Number two, and you all know this as practitioners out there, you can't hire people. In this case, let's say Mike and Sarah had, they're part-time employees. They couldn't afford to maintain them or give them the hours they wanted. Guess what they got? PUA, pandemic unemployment, in addition to whatever their state was providing them. So Mike and Sarah are running the business by themselves. You mean to tell me that if they reach out to a family member who knows that they really need help, that they couldn't pay their family member and get some credit for that? This is outrageous. There's no logic and reason to this. None. Zero. And then they go back, they have other examples. Just rinse, repeat. Change the corporation name to anything. Tattoo parlors. I have one. Two lovely girls who are smart and awesome. Okay. They had to shutter their doors. Apply this to anybody. Cleaners, flower shops, boutiques, you name it. I mean, hair salons. Apply that. Put names in businesses and individual names in these examples, and you see how unbelievably unfair that this applying 267 in those situations is. And that's why, as practitioners, we dismissed this early on because it was too shocking to even believe that was the intent of Congress. Okay, and I will remind you, the people that are want to believe they're right, and this is not about right and wrong. This is about helping each other survive. There's no right or wrong here. We want practical, good solutions for people that are not arbitrarily excluded from a credit that's benefiting millions of other businesses. I mean, think about the full-time equivalent relaxation rules on those for bigger businesses. Think about that. So what we're doing is taking away these credits from these smaller businesses and essentially transferring them over to bigger businesses with more employees. Is that the intent of Congress? If this was laid out more explicitly, to just say, if indeed notice 2021-49 is going to be the final guidance, it is at this moment in time. Basically what they're saying is ERTC, you qualify for it unless you're a small business owner. Is that what Congress wants? Who are our representatives? Who's representing us? And I have some takeaways here. These are more of a rant. So I've done multiple videos of this where my emotion got the best of me. So I'm doing this other one to just kind of calm down. But it is frustrating. It's unfortunate, and I don't think we're done. I don't think we're done lobbying and trying to convince people with authority and with the ability to influence and steer this conversation in a way that helps us figure this out, because as I've laid out here, it simply makes no sense. Okay, it makes no sense that you can have you can indicate an intent by Congress in certain sections and not others. It makes no sense that this is called the American Rescue Plan Act. We've just come through a catastrophe and we're still dealing with it. It makes no sense. And I will finally state my position and others who interpreted FAQ, which yes is not authoritative, but we still use it. That's what this guidance is all about. It helps us interpret things. This related is any employee. This is the qualifier for us essentially dismissing what's in section 51I1, not dismissing it, but qualifying. And how else can we apply these rules that make sense according to this guidance here and in the act itself? I don't know. I mean, I think there's still a lot of work to do, but for now, I pulled down a lot of my videos on S Corp 100% owners. I pulled down, as many videos as I can so not to confuse people. And I will keep an eye on this. Obviously, I welcome your comments, and I welcome your venting of frustrations as well. Let's get some emotion out there. And regardless of political party, this has nothing to do with the one thing I will say, the biggest takeaway here is that big business and big government are absolutely working together, and they are a much more effective, especially big business lobby group, than the small businesses. And we rely on our government officials to balance that out, and they're not doing their job, regardless of your political party. So that's about as far as I'll go on the politics of it. With that, I will keep you posted. Please share any other information that you receive, especially practitioners out there. I want to thank Dan again, Shoden. He's got I'm going to link an article here. And Dan's been on top of this as far as attribution rules. He's been on top of it, and I really appreciated his quick response to me after I posted my video the day before, because this notice 2021-49 came out just yesterday. So I appreciate that, Dan. And thank you everybody else that's across the country. Marie in Connecticut, Carol in Wisconsin, so many other people I'm forgetting right now that I have established some relationships with. And so thank you all. I will check back soon. All right. Have a great weekend. I know it's Thursday, but I think after this, I'm done for the week. Goodbye, everybody.